A credit squeeze is cooling faster than the fever, but leaving a residual chill. Small caps are running hot on cash, while big tech holds steady. The question isn't whether volatility returns, but whether this relief wave creates immunity or just masks infection. The data is screaming that fear has been flushed from the system too quickly. UVXY dropped 2.8% as hedging unwound in force. VIXY and VXX both retreated nearly 2%, confirming capital rotated back into risk assets rather than defensive positions. The consensus among the Canary community is that this relief move lacks foundation. No catalyst has explained why hedgers suddenly abandoned protection en masse. Our metrics confirm a hidden pulse problem beneath the surface calm. CRE shed 1.11%, as regional banks faced margin pressure from commercial real estate exposure. SPHB dragged down 1.55%, exposing that small-cap financials are more sensitive to rate uncertainty than the broader market suggests. The indicators are signaling credit spreads may be a leading indicator rather than trailing, meaning tighter conditions could arrive before earnings reveal them. The Canary dashboard shows fear is cooling but not gone. UVXY's 2.8% drop masked what was actually a nervous rotation rather than true comfort. VIXY and VXX both retreated close to 2%, as investors hedged selectively instead of broadly. The data indicates volatility pricing is disconnected from fundamental stress, which means any new headline could spike the gauge back toward fever territory within hours. Tech's engine ran flat. SMH gained 0.26%, while IWM dragged down 0.61%. This divergence suggests earnings surprises are limited and capital allocation is patient rather than aggressive. The indicators confirm that consumer discretionary, XLY 0.45, held steady, but industrial exposure, IYT 0.61, shows manufacturing demand remains fragile despite oil's 4% rally. Bonds flatlined. TLT down 0.64%, bond 0.34%, as yields stabilized without a flight to quality. GLD retreated 0.74% despite the oil spike, which means investors view energy as cyclical rather than protective. The data indicates safety premiums are compressing prematurely. Any geopolitical flare-up would require a reset in pricing that takes time to fully absorb. The portfolio hero is breathing easier, but the market's villain, credit uncertainty mixed with oil volatility, hasn't been defeated, merely temporarily suppressed. Energy prices rising 4% while gold holds steady creates an asymmetry. If supply tightens further, energy becomes the new safe haven rather than traditional assets. The Canary community consensus is that this relief wave extends protection only to active traders who recognize when fear has been priced out without cause. Volatility has cooled faster than fundamentals warrant, creating a false sense of stability that will test whether immunity holds or infection returns. Watch oil prices. If they break 85 with no supply resolution, the real cough begins tomorrow rather than today. This is the Canary Report, your diagnostic voice in an uncertain market.